It's wild how fast things move these days, especially, when it comes to money.
Hmm.
You see a headline, maybe even just a rumor online, and suddenly a stock price is doing acrobatics.
Yeah.
It makes you wonder, what's really driving these moves?
Well, it really highlights how interconnected our information and financial worlds have become, doesn't it? And just how quickly emotions and opinions, sentiment can take hold and influence market behavior.
Exactly. And that's where we dive deep. Welcome to the deep dive, where we take a mountain of information and extract the golden nuggets you need.
Mm.
Today, our mission is to unravel how all that media buzz, the good and the bad vibes around companies, actually impacts their stock values.
Right.
And maybe even more fascinating, we're going to explore the crucial role that reliable company earnings announcements play in, well, keeping things honest.
And for this deep dive, we're looking at some really compelling academic research. It's a study that analyzed a massive amount of data. We're talking millions of news articles and over 10 years of stock market activity. Yeah, it's like getting this huge macro view of how the news and the market interact.
Okay, so the big question we're tackling is, can all the hype or
Sure.
negativity in the media actually cause stocks to become mispriced? Like, are investors getting swept away by the headlines?
Mhm.
And if they are, how do those regular, predictable quarterly earnings reports act as a kind of reality check, bringing valuations back down to earth?
That's the core of it. And the research we're unpacking today reveals some pretty surprising insights into market behavior. It really underscores the often underappreciated power of those quarterly earnings releases.
Yeah.
It's not just about the numbers themselves, it's about their ability to sort of anchor our expectations.
Okay, let's unpack this then.
Yeah.
We're talking about the influence of media sentiment first.
Uh-huh.
What was the core question this study was really trying to answer there?
So, at its heart, this part of the study wanted to see if those regularly scheduled earnings announcements actually work to correct any potential mispricing, right? Mispricing that might have happened because of all the media sentiment surrounding a company during the preceding 3 months.
Okay.
They were basically looking to see if news headlines could cause these temporary price distortions that are then resolved when the company finally reveals its financial performance.
And what did they find, specifically about, say, negative news coverage? And what happens around those earnings announcements? Because you said it gets interesting here.
Yeah, this is fascinating. What they found is that when a company has been getting a lot of negative press during a quarter, its stock tends to see lower returns around the time of its earnings announcement.
Lower returns. So the negative press leads to a bad earnings reaction.
Or,
Well, think of it this way.
yeah,
The takeaway seems to be that all that negativity in the news might actually be a signal.
Yeah.
A signal that maybe the earlier enthusiasm, if there was any positive sentiment before that, was perhaps overblown.
and a correction is coming when the earnings are actually announced. It's like the market, sobers up when the actual numbers come out.
So it's like the market gets a bit too excited by maybe some good news, fueled by positive articles, and then the earnings report lands and says, hold on a second, let's look at the real scorecard.
Precisely, yeah. And the study touches on this idea that some investors, perhaps those more focused on short-term price movements, might give too much weight to that media sentiment when they're trading,
Instead of the fundamentals.
instead of focusing on the fundamental long-term value of the business. Exactly.
Yeah, that makes total sense. I mean, it's easy to get caught up in the news cycle, right? Especially with information just flying at us constantly.
And this connects to an interesting concept called higher order beliefs.
Okay.
Essentially, it's not always about what the company is fundamentally worth right now, but what everyone thinks everyone else thinks it's worth.
Like predicting the crowd.
Sort of. Some investors try to predict what others will do based on these public signals, like media coverage. And this can cause prices to temporarily move away from what the company's fundamentals suggest it's truly worth.
So it's like a short-term popularity contest. People buy a stock because they think other people will buy it too, pushing the price up, even if the underlying business isn't necessarily justifying it yet.
Exactly. And to really get a grip on this, the researchers used a massive data set from Ravenpack. They looked at over 6 million media articles.
It was a million? Wow.
Yeah, from thousands of different news sources over that 10-year period. So this gave them a really broad view of the whole media sentiment landscape for companies.
6 million articles. Okay, that's a lot to keep track of. How did they even begin to measure the overall feeling, the sentiment in all that data?
Well, they primarily used Ravenpack's Event Sentiment Score, the ESS. Now, this score goes from 0, which is very negative, up to 100 very positive, with 50 being neutral.
Right.
The researchers then adjusted the scale so that 0 represented neutral sentiment, just to make it a bit easier to work with.
Okay.
Then, for every company on any given day, they just added up the adjusted sentiment scores from all the articles published about it, and then they totaled this daily sentiment over the entire quarter leading up to the earnings announcement.
Okay, so they got a general sense of whether the news around a company was mostly positive or negative each quarter. But I'd imagine that not all news articles have the same impact, do they? Like a small blog post probably doesn't sway the market as much as a big story in a major financial paper.
That's a really crucial point, and the study absolutely accounted for this. They created several different ways to measure media sentiment, not just summing up the raw scores.
How so?
Well, for example, they developed measures that weighted the sentiment based on how much a particular news outlet seemed to influence trading volume in the past. They looked at historical data for that.
Interesting. So a positive article in, say, a widely read financial paper would carry more weight in their calculation than a similar article from a less influential source.
Precisely. And they also considered how, well, new the information in an article was.
Ah, novelty matters.
Yeah, they gave more importance to articles that presented unique information and less weight to those that were just sort of repeating news that was already out there.
Makes sense.
They even created a combined measure that looked at both the influence of the news outlet and the uniqueness of the article.
Wow, okay, that sounds pretty thorough. They really tried to pinpoint the real impact of the media buzz, huh?
Absolutely. And perhaps most importantly, they developed this other measure they called sentiment-driven returns.
Sentiment-driven returns. What does that mean exactly?
Well, think of it like trying to isolate the sound of just one instrument in a whole orchestra, right? We're trying to filter out all the other market noise and see just how much the media sentiment instrument is influencing the stock price on its own. So they estimated the portion of daily stock returns that could be directly linked just to media sentiment, after accounting for other things like general market trends, industry news, fundamental news about the company, all that stuff.
So stripping out the other factor.
Exactly. This helped them really focus on the pure effect of the sentiment itself.
And across all these different ways of measuring sentiment, the simple sum, the weighted ones, this sentiment-driven return, did they see a consistent pattern? What was the main takeaway?
Yes, remarkably consistent. Across all these different measures, they found that higher positive media sentiment during a quarter tended to come before lower, or sometimes even negative, returns right around when the company announced its earnings.
Okay, so more hype before earnings often meant a disappointing reaction at earnings.
Pretty much. It strongly suggests that the initial positive buzz might have led to the stock being a bit overvalued, and then that overvaluation got corrected when the actual hard earnings figures were released.
So it seems like all that media hype can inflate a stock's price, at least temporarily, and then the earnings announcement kind of acts like a pin to that balloon.
That's a good way to put it.
Now, let's talk more about how these earnings announcements act as that disciplining force. Why are they so good at correcting this potential mispricing you mentioned?
Well, the key idea here is that earnings announcements are seen as highly reliable pieces of information. I mean, think about it. They're based on audited financial statements.
Right, there are rules.
Exactly. They happen on a regular schedule that investors know well in advance, and they are very, very closely watched by the entire market. So this makes them a really important coordinating event.
Coordinating that.
Yeah, a moment when everyone kind of refocuses simultaneously on the actual financial health and performance of the company, the fundamentals.
That makes a lot of sense. Compared to the often changing and sometimes sensational nature of media sentiment, earnings reports are much more solid, verifiable.
Precisely. Media sentiment can be influenced by all sorts of things, right?
Yeah.
Catchy headlines, general market mood, maybe even intentional manipulation sometimes. Earnings, on the other hand, are supposed to be a direct report card on how the company actually performed financially. The study even mentioned the SEC taking action against some hedge funds for allegedly manipulating media sentiment for short-term profit.
Really?
Yeah, which really highlights how disconnected prices can sometimes become from the underlying value, potentially driven by the sentiment.
It's a good reminder that not everything you read, even in financial news, is necessarily objective or focused on, long-term investing.
Absolutely. And it brings up an interesting point about that ongoing debate around quarterly reporting itself.
Hmm.
Some argue it makes companies too focused on just hitting the next quarter's numbers.
Yeah, the short-termism argument.
Right. However, this study's findings suggest a potential upside to this regular schedule.
Yeah.
Its ability to curb mispricing that might be driven by sentiment run wild.
Ah, so while there might be some downsides to that short-term focus, the quarterly earnings announcements seem to play this vital role in keeping the market somewhat tethered to reality.
That's a key insight, yeah. It acts as that regular reality check.
Okay, now let's dig a little deeper into maybe who might be behind these sentiment-driven price movements and under what kinds of market conditions this effect is most noticeable. What did this study tell us about investor behavior?
This is where it gets really interesting, too. The study looked at different types of investors trading the stock, and they found that this negative link between positive media sentiment before earnings and lower returns at earnings was strongest when there was a lot of trading activity from both individual investors.
Okay, like retail traders.
Yeah, your everyday traders, and also what they call transient institutional investors.
Transient institutional investors. What's the difference there? Who are they?
So individual investors, as you said, retail traders, might be more likely to be swayed by media sentiment, maybe less focused on deep financial analysis sometimes. Transient institutional investors, on the other hand, are larger players. Think some types of hedge funds or mutual funds, but they often have a shorter-term trading focus.
Not long-term holders.
Right. They might jump into a stock that's getting a lot of positive buzz, not necessarily because they believe in the company for the next 10 years, but because they think they can ride that wave of enthusiasm and maybe sell before it crashes or right at earnings.
So it's like the maybe less experienced investors react to the news, and then these more sophisticated short-term traders try to potentially profit from that reaction.
That's one way to interpret it, yes. The study suggests that for this sentiment-driven mispricing to really take hold and then get corrected at earnings, you might need this combination. You need that initial reaction, perhaps from those more influenced by media, and then you need other investors willing to trade on that momentum in the short term.
Okay. What about the companies themselves? Did the study find that media sentiment had a bigger impact on certain kinds of companies?
Yes. Definitely. They found that when there was more fundamental uncertainty around a company, the effect of media sentiment was amplified.
Fundamental uncertainty. Like what?
Well, for example, companies that invest heavily in research and development, where future payoffs are hard to predict, or companies with a history of really volatile, unpredictable earnings, or even companies that have had recent losses.
Ah, okay.
For these kinds of firms, the link between media sentiment during the quarter and what happened to the stock price at the subsequent earnings announcement was stronger.
That makes intuitive sense, right? If it's genuinely harder to figure out a company's true value from its financials alone, investors might be more inclined to grab onto public signals, like media sentiment, as a guide.
Exactly. It's like when the financial picture is cloudy, you pay more attention to the headlines, maybe grasp onto them more.
Yeah.
And the study also looked at the role of something called arbitrage constraints.
Arbitrage constraints. Sounds technical. What's that about?
Think of it like this. If a stock price gets inflated, maybe due to hype, some savvy investors might want to bet against it, right? That's short selling.
Right, betting the price will fall.
Exactly. Arbitrage constraints are things that make it difficult or expensive to do that. The study used the cost of borrowing shares, which you need to do to short sell, as a proxy, a measure for these constraints.
Okay, so how does the difficulty of short selling relate to media sentiment and earnings?
Well, when it's easy and cheap to short sell a stock that seems overvalued because of positive media buzz, investors who think it's overvalued can step in, make their bets. And that selling pressure itself can help bring the price back down towards a more reasonable level, even before earnings.
The market forces at work.
Right. But when it's difficult or costly to short sell, when those arbitrage constraints are high, that correction mechanism is weaker. It's harder for the skeptics to push the price down.
And what did the study find then, when short selling was harder?
They found stronger evidence that earnings announcements act as that price correction mechanism when short selling was more difficult, especially after periods of positive media sentiment. It suggests that when it's harder for arbitrageurs to bet against a potentially hyped-up stock, the earnings announcement becomes even more critical in providing that reality check and bringing the price back in line with fundamentals.
So it's like the earnings report has to step in and do the heavy lifting that short sellers might otherwise have done if it weren't so difficult or expensive for them.
That's a really good way to think about it, yeah. The earnings become an even more important anchor point in those situations.
Okay. Now, the study also used another interesting technique you mentioned to really pinpoint the impact of those moments of extreme positive or negative news. Can you tell us a bit about this Midas method they used?
Yes, the mixed data sampling or MIDAS approach. It sounds a bit complex, but the idea is actually pretty neat in this context.
How did it help here? Did it let them sort of zoom in on the really noisy news days?
Exactly. MIDAS is a statistical way to look at data that's measured at different frequencies, like daily stock returns, which happen every day, and quarterly earnings announcement returns, which happen once a quarter, all within the same model.
Mm-hmm.
So it allowed them to specifically analyze the relationship between the stock's return on days with really high positive media sentiment or really low negative sentiment, and what happened to the stock price when the company later reported its quarterly earnings.
So instead of just looking at the overall average mood of the news during the whole quarter, they could isolate those specific days when the buzz was loudest, whether it was good or bad.
Precisely. They could zero in on those extreme sentiment days, and what they found was pretty compelling.
Which was?
Those days with extreme media sentiment had a significantly negative correlation with the returns observed later at their earnings announcement. And this correlation was stronger than on days without such strong media coverage.
Wow. So a really hyped up day before earnings was an even stronger signal of potential disappointment at earnings.
That's what the evidence suggests. It provides even more support for the idea that these big price swings, driven purely by sentiment, tend to get corrected or reversed when the company releases its actual earnings numbers.
It really does seem to reinforce that central theme, doesn't it? The market can get a bit carried away by noise in the short term, but eventually the fundamentals, as revealed through earnings, tend to take over.
Mm-hmm.
Now, one question someone listening might have is, well, couldn't this media sentiment just be reflecting early leaks or hints about the actual earnings information? Maybe the news isn't causing the mispricing. Maybe it's just anticipating the earnings. How did the researchers address that possibility?
That's a very valid point, and yeah, the researchers definitely considered that. They called it the preemption hypothesis.
Okay.
They reasoned that if media sentiment was simply picking up on early earnings news, if the market was already getting hints, then we should see less of a reaction to the actual earnings announcements themselves, right?
Right, because the news would already be baked into the price.
Exactly. If the information, or at least the direction of the surprise, was already partially out there via the media, the official announcement shouldn't cause such a big stir. But what they actually observed were significant price adjustments happening at the time of the earnings announcements, particularly after periods of high sentiment.
So the market was still surprised, suggesting the media hadn't fully revealed the earning picture beforehand.
That's the interpretation. They also did another test, what they called an intra-period price timeliness analysis.
Okay, what did that involve?
Basically, they looked at whether stock prices were adjusting more quickly during the quarter, day to day, in response to media sentiment. The idea was if sentiment was just a proxy for leaked earnings news, you'd expect prices to move more swiftly and incorporate information faster during the quarter when sentiment was high.
And did they find that?
No, they didn't find evidence of this faster price formation being driven by media sentiment. This further suggested that the media sentiment effect is something distinct from just anticipating the earnings news early.
So putting it all together, it sounds like they built a pretty strong case that this effect of media sentiment on stock prices and its subsequent correction at earnings is a real phenomenon, separate from just early information about the earnings themselves.
They did. I mean, no single study is ever the absolute final word. But their comprehensive analysis, using multiple measures and robustness checks, really points strongly towards quarterly earnings announcements serving this crucial, perhaps underappreciated role.
A role in keeping stock prices connected to the underlying value of companies.
Exactly. By counteracting potential mispricing that can be temporarily caused by swings in media sentiment.
Okay, so to bring it all together as we kind of wrap up here, what's the big picture takeaway from this deep dive into the research? What should listeners really hang on to?
I think the main insight really is that those regular quarterly earnings announcements play this incredibly important and maybe often underestimated role in keeping the stock market somewhat efficient. They act as a vital counterbalance.
A counterbalance to what?
To the potential for media sentiment, the hype, the negativity, to push stock prices away from their true fundamental values. Earnings help to correct any temporary mispricings that might occur because of that sentiment.
It's fascinating, isn't it? How this regular, almost routine event, the quarterly earnings report, can have such a significant impact on the market's ability to stay, well, grounded.
Hmm.
It really highlights that while news and sentiment can definitely influence how we perceive things in the short run, the consistent discipline of financial reporting helps, eventually, to bring expectations back in line with economic reality.
Exactly right. And this raises a really important practical question for you listening, I think. In our increasingly fast-paced world, flooded with information, how can you, as an investor, try to tell the difference between genuine insights and just noise driven by sentiment?
That's the million-dollar question, isn't it?
It is. And maybe, how can you use the predictable rhythm, the schedule of earnings announcements to potentially make smarter, more informed investment decisions?
It's definitely something to think about as you navigate the constant stream of financial news and market chatter. Understanding this dynamic, this relationship between media sentiment and the anchoring power of earnings could be a really valuable tool for your own investment strategy.
Absolutely. And this deep dive really, it just opens up even more questions, doesn't it, about the complex interplay between information, human psychology, sentiment, and ultimately how well our markets actually work. There's always more to explore in these fascinating dynamics.